Welcome to Talk Tickers, your deep dive into the numbers and narratives shaping the market.
Today we're jumping into RLI Corp. They're a specialty property and casualty insurer, and we're looking at their Q3 2025 earnings release and the management call that happened October 21st.
Right, and our goal here is really to cut through the usual jargon. We want to connect the dots behind what RLI did this quarter, because honestly, it felt like a masterclass in underwriting discipline and capital strength, even when, growing the top line was clearly a challenge.
Yeah, definitely. The first impression from the numbers, really positive. Operating earnings per share came in at $0.83.
83 cents. And how did that stack up against expectations?
It was a solid beat,
Right.
roughly 34% better than the Zacks consensus, which is pretty substantial. Cap EPS, by the way, was $1.35.
Okay, strong beat on operating EPS. But, in specialty insurance, the number everyone watches is that combined ratio. How did they do there?
Exceptionally well. They posted an 85.1.
85.1. Wow, that's a huge improvement from last year, right? Wasn't it closer to 90?
Exactly. It was 89.6 in the prior year period. So dropping below 86 is really quite pristine. It basically means for every dollar of premium they collected, they spent just over 85 cents on losses and expenses.
Leaving almost 15 cents of pure underwriting profit. That's before even looking at investment income. That's really strong.
It really is. Now, consolidated revenue, that grew 8.4% to $509.7 million, though there was a little bit of noise there.
Oh, what kind of noise?
Well, some of the external trackers, the ones looking maybe more at just sales or operating revenue, they had the number around $449 million, and the estimate there was closer to $453 million.
Okay. So a minor miss against some specific external views, probably down to how different revenue bases are calculated.
Precisely. Not a huge deal given the overall strength, but worth noting. The core operational leverage, especially from that underwriting profit, was definitely there.
And how did the market take it?
Positively, but maybe a bit muted, the stock closed up 2.8% on the day at $61.30.
2.8%. Decent, but you might expect more with that kind of EPS beat and combined ratio.
Well, the options market volatility going into the print implied maybe a bigger move, like 5.4%. So, yeah, perhaps the lack of a huge top-line growth surprise kept a lid on things a bit. Investors liked the quality, clearly, but maybe wanted more growth signal too.
Okay, let's dig into that 85.1 combined ratio. Was it just good luck with catastrophes, or was it really strong execution?
Management would say, and the numbers support, it was driven by execution. Underwriting income jumped to $60.5 million. That's way up from $40.7 million last year.
$60.5 million, that's a big leap.
Huge. And they attributed it directly to, quote, disciplined underwriting and consistent execution.
I suspect it's a bit of both, though, right? I mean, Q3 last year did have significant storm losses.
Absolutely. That's a fair point. Q3 2024 included, I think, $37 million in cat losses. The absence of that this year was definitely a major factor, a tailwind.
But, and this is key, I think, that amazing 85.1 wasn't just good luck from the weather mat. It really validates their strategy, doesn't it? They've been consciously shrinking their catastrophe-exposed property book.
Right.
So when the storms didn't hit big this quarter, they were perfectly positioned to reap the rewards because they'd already managed down that specific risk. It shows the discipline paid off.
That's a great way to put it. And that strategic thinking, that discipline, it runs right through to the balance sheet, too. The capital compounding story at RLI just continues.
Okay, talk about the balance sheet metrics. What stood out?
Well, first off, book value per share. It increased 26% just since the start of the year.
26% year to date. That's massive. And does that include dividends paid?
It does, yes. Includes dividends already paid out.
And that's why it matters, right? Because it shows the underlying business is generating so much profit, so much capital, that they can actually return cash to shareholders and still grow the intrinsic value of the company by, well, over a quarter in just 9 months. Impressive stuff.
Very impressive. And fueling that, you saw net investment income climb 12% to $41.3 million.
Okay, solid growth on the investment side, too.
Yeah, and the operating cash flow was really strong, $179 million just in the quarter. And what they did with that cash is important.
What did they do? Buying back stock? Or deploying it?
Deploying it into fixed income. They were buying bonds with average yields of 4.8%.
4.8%. And how does that compare to what their existing portfolio is yielding?
That's the crucial part. It's about 70 basis points higher than the current book yield of their existing portfolio.
Right. So they're using that strong cash flow to lock in higher future investment income. That's another tailwind building up.
Exactly. And one more point on the quality of the results. They also recognize $13.7 million in favorable prior year reserve development.
Ah, releasing reserves, meaning they previously set aside more money for old claims than they actually needed.
Precisely. And the fact that it happened across all three of their segments, property, casualty, and surety, suggests it's not just a one-off fluke in one line. It speaks to their sort of consistent accuracy in setting loss reserves initially.
Okay, so strong underwriting profit, strong balance sheet growth, favorable reserve development. But we mentioned the top line pressure. Let's break down the segments to see where that pressure is coming from and where the profit is. How did the segments perform on combined ratio?
Let's start with property. That segment absolutely crushed it with a 60.2 combined ratio.
60.2. That's almost unbelievable. That's where the lack of catastrophes really showed up, I imagine.
Absolutely. That was a primary beneficiary. But here's the trade-off we keep mentioning.
Let me guess. Premium volume.
You got it. Premium in the property segment was actually down 11% overall.
Down 11%, even with that incredible profitability. So they're consciously letting business walk away. Why? Competition. Rates.
Both. Management talked about competition heating up, especially for catastrophe-exposed business, and rate pressure emerging there. So they chose to maintain their underwriting standards, protect that incredible margin, even to prevent shrinking the book.
Okay, discipline in action. What about the casualty segment?
Casualty came in with a 98 combined ratio. So pretty much break even on the underwriting side.
98. Okay, not losing money, but not a big profit driver like property this quarter. How is growth there?
Growth was decent. Gross premiums were up 8%. And that segment also benefited from some of that reserve development we mentioned, about $8 million worth.
Got it. And the third leg of the stool, surety.
Surety was solid, as it usually is for RLI, an 85 combined ratio. Very consistent.
85. Nice. Similar profitability to the overall company average and premium growth in surety.
Actually, premium was down slightly there, too, by 3%.
Down 3%. What was the story there?
Management pointed to a couple of things. Some softness in construction projects, particularly in the small to mid-market space, and also a bit of a slowdown in energy renewable projects, which had been a source of surety demand.
Okay, so property shrinking significantly due to discipline, casualty growing moderately, surety down just a touch due to market conditions. It paints a picture of very selective participation.
Exactly.
Yeah.
But it's not all contraction. They are finding specific pockets where they can grow profitably and leaning in hard.
Like where? Give us some examples.
Personal umbrella insurance is a great one. Premium there surged 24%.
24%? That's huge growth. Was that just volume or rates too?
Both, but significantly driven by rate. They achieved a 17% rate increase in personal umbrella.
17% rate on top of that growth. Nice. Any other bright spots?
Yeah, another interesting one was Hawaiian homeowners insurance. That line grew 33%.
33%. Why Hawaii specifically?
Market disruption. Seems like other carriers might have pulled back or run into trouble there, creating an opportunity for RLI. And because of that disruption, they were able to get a 16% rate increase as well.
Okay, so that's textbook specialty insurance, right? Finding dislocations and getting paid well for stepping in.
Exactly. But then you see the flip side, the discipline leading to contraction in other areas. Look at their E&S property business that's excess and surplus lines.
Right, the non-standard higher risk property stuff. How did that do?
Premium there was down 20%.
Down 20%. Wow. Why such a sharp drop?
Well, remember Hurricane Milton last year? It ended up mostly missing the coast. Didn't cause the massive losses some had feared.
I remember.
So after that near miss, a lot of new insurance capacity, new capital, rushed into the E&S property market thinking it looked attractive. That new capacity started competing hard on price and terms.
And RLI essentially said, no thanks to that competition.
Pretty much.
Yeah.
They saw terms loosening, rates coming down. Wind renewal rates, for example, actually declined 11% in the quarter for them. So RLI just stepped back rather than write business they felt was underpriced.
Again, discipline over volume. It's a consistent theme. What about transportation? That's often a tricky line.
It really highlights the tightrope walk. Transportation premium was down 1% for the quarter.
Down just 1%. Okay, seems stable enough. But what were rates doing?
That's the kicker. They actually achieved a 15% rate increase in transportation.
Wait, they got 15% more rate, but the total premium collected still went down? How does that work?
Simple. Clients left. Management noted that some large accounts canceled their policies midterms, specifically to go find lower-cost alternatives elsewhere.
So RLI held the line on pricing, saying, this is what we need to charge for this risk, and some clients just couldn't or wouldn't pay it and walked.
Exactly. It perfectly illustrates that underwriting first culture. They're willing to lose the volume if the price and terms aren't right for the risk they're taking on.
That takes real conviction, especially when competitors might be chasing that business.
It does. And you also saw a strategic shift within that growing personal umbrella line we talked about earlier.
Oh, yeah. What kind of shift?
They started implementing higher minimum attachment points for new policies in some major states, like California and Florida.
Attachment points. You mean the amount of underlying insurance someone needs before the umbrella policy kicks in?
Exactly. They moved the requirement for new business from, say, $250,000 of underlying liability coverage up to $500,000 in those key states.
$500,000. So what's the strategic thinking there?
It's about reducing frequency. By pushing the attachment point higher, RLI is essentially saying they want to focus on ensuring the really large, less frequent, truly catastrophic liability losses. They're leaving the smaller, more predictable, more frequent claims, kind of the noise just above standard policy limits for the primary insurance carriers to handle.
Ah, okay. So it's another way to refine the risk profile and protect profitability, even within a line that's growing quickly overall. Very selective.
Very selective. Now, we should also touch on expenses. The expense ratio did tick up a bit.
Right, I saw that. What's driving the higher expenses? Is that a concern?
It's driven by a couple of things. Higher acquisition costs, which makes sense, especially in those lines that are growing rapidly, like personal umbrella, where you might pay higher commissions.
Okay, spending money to get that good growth. What else?
They also explicitly mentioned continued investments in technology, in their people, and in processes. They even specifically called out exploring generative AI.
Interesting. So they view these higher expenses now as investments needed to generate profitable growth and operational leverage down the road.
That seems to be the message. They're investing to make the business more efficient and effective long-term, focusing spending on areas that support that selective, profitable underwriting strategy. They seem willing to accept a bit of near-term margin pressure on the expense side for that future benefit.
Okay, that makes sense. So connecting all this back to the bigger picture and maybe what management is signaling, what was the overall tone on guidance? Did they give specific numbers for Q4 or next year?
No quantitative guidance, which is pretty typical for them. But the tone was absolutely clear and consistent with everything we've discussed. The focus remains squarely, almost religiously, on profitability over volume.
Sticking to their knitting.
Absolutely. They have this multi-decade culture of underwriting first, and they reinforce that. They even said they are perfectly fine with a, quote, top-line flat quarter. And remember, premium was only up 2% year to date if that's what it takes to maintain their target risk-adjusted returns.
That really puts the quarter in perspective. And it's important context for investors too, right? Because the stock wasn't exactly flying high coming into this report.
Not at all. It was near 52-week lows. Year-to-date performance was pretty rough, down over 25% before this earnings release.
Down 25%? Ouch! Even though the broader P&C insurance sector has actually been doing reasonably well.
Yeah, the sector generally is benefiting from decent rate adequacy in many lines and, of course, those higher investment income tailwinds we talked about. So RLI's operational beat, that strong execution, kind of stands out even more against that negative stock performance backdrop.
So the market was maybe overly focused on the growth challenges heading into the print?
It seems possible. And those growth challenges, particularly in property, are real. That competitive dynamic, the softening property market, that's a genuine headwind.
Right, especially in E&S property where that new capacity came rushing in after Hurricane Milton missed. Rate and term pressure is intense there.
And management was just completely unambiguous about it on the call. They will prioritize keeping well-priced, well-structured books of business over chasing market share in that environment, period.
Okay, so looking ahead, what are the key things listeners should be watching? What are the potential catalysts, positive or negative?
Well, first, you have to keep watching the pricing and terms in those competitive lines, especially casualty lines like transportation. Can they continue to get rate? Will they have to keep shedding volume? That balance is critical.
Makes sense. What else?
Second, definitely keep an eye on that investment income trajectory. They locked in that 4.8% yield on new money this quarter. Seeing that flow through and continue to boost net investment income will be important.
Right, the built-in tailwind.
And third, and this could be a big one for shareholders, potential capital actions.
Ah, like dividends or buybacks.
Exactly. Given RLI's history of returning capital to shareholders, and especially given that huge 26% year-to-date growth in book value, the potential for a special dividend has to be on the table.
Because if they're consciously shrinking in certain areas like property to maintain discipline, that capital isn't being deployed for growth there.
Right. It's building up, it's being freed up. And RLI has a track record of not letting excess capital just sit idle on the balance sheet for too long. So return of capital becomes a very relevant potential catalyst.
Okay, that leads us perfectly into our next segment. Just a reminder for everyone listening, this is not financial advice.
That's right. This next part is purely for entertainment, for discussion. It is absolutely not investment counsel. Please, always consult with your own professional financial advisor before making any investment decisions.
Okay, disclaimer delivered. Let's hear the outrageous but plausible trade idea based on this RLI quarter.
All right, so building directly on what we just discussed. You have RLI generating exceptional amounts of capital again. That 26% year-to-date book value growth is the anchor. And at the same time, they are deliberately, aggressively culling their catastrophe-exposed property risk precisely because the market is softening and they won't compromise standards. This frees up even more capital.
Okay, got the premise. Strong capital generation plus capital being freed up by underwriting discipline.
So the core belief here is that the market is significantly underappreciating the likelihood of RLI returning a chunk of this capital to shareholders in a non-recurring way.
I mean, a special dividend.
Exactly. So the pitch, the outrageous but plausible trade is go long RLI stock. But you're specifically targeting the potential announcement of a substantial special dividend, maybe in Q4, maybe early Q1 next year.
And the logic is simply that this capital has to go somewhere. If they're choosing not to chase growth, returning it is the logical next step for a shareholder-focused company like RLI.
That's the core thesis. Discipline implies capital return potential when growth opportunities meeting their strict criteria are scarce.
Okay, that's the long side. Is there a hedge or a pair for this trade?
Yes. To make it a bit more targeted, you could hedge this long RLI position by simultaneously going short a peer company, specifically short a specialty P&C insurer peer that is, right now, publicly talking up its high premium growth, maybe boasting about market share gains.
So you're betting against a company that might be doing the opposite of RLI, chasing volume, potentially compromising underwriting standards, especially in that soft property market that RLI is actively avoiding.
Precisely. The short side is a bet against potentially undisciplined growth in a softening market. The overall trade, long RLI, short the growth chaser, becomes a pure play bet on the value of capital discipline and underwriting quality over just hitting top-line numbers.
A bet on RLI's proven playbook, essentially.
You could say that. It's a bet that management's actions this quarter, reinforcing that discipline, will ultimately be rewarded more than chasing volume in current market conditions.
Interesting. Okay, let's wrap things up. To recap the core narrative from RLI's Q3.
Yeah, I'd say it was a really high-quality earnings beat. It was built fundamentally on strong, disciplined execution, leading to that excellent sub-86 combined ratio.
Right, and significant capital growth, that 26% book value increase year to date, really stands out.
But they achieved this despite facing those undeniable competitive headwinds, which forced them to actually contract in key segments like E&S property and transportation, where they couldn't get the terms they wanted.
So management's focus seems crystal clear. They mentioned aiming for their 30th consecutive year of underwriting profit. 30 years.
An incredible track record.
It really is. And that brings us to the final provocative thought for you, the listener, to chew on. Does the market today correctly value that kind of decades-long consistency, that unwavering discipline? Especially in an environment that often seems obsessed with short-term, quarterly growth rates above all else.
Or, put another way, is RLI's current valuation, even after the post-earnings bump, still kind of anchored to the stock's really difficult performance leading into this strong report, perhaps overlooking the underlying quality and capital return potential?
Something to think about.
Definitely. We'll let you mull that over.
Thanks for tuning in. We'll see you on the next deep dive.